Today's Monday, February 6th, 2023, back for another daily review. Have a lot to get through tonight. I'm going to try to make it as quick as possible, but there's so much great stuff to talk about on Nasdaq and S&P. But really fast, I quickly just wanted to show, because it's freshly on my chart, this is Aussie dollar, New Zealand dollar from Asia session. So I wanted to just show a couple quick examples of the opening range for Asia session. And clearly you can see we have a type 3 situation, type 3 opening range setup. So using the Asia open as our opening price, we can see that we have the same type of thing. We have this false start, price shoots up on New Zealand dollar, comes back down and holds above the open. Here, if maybe I go to like a 2 minute. And here we get the divergence on Aussie dollar, where price makes kind of these lower lows here into this imbalance. Then we get this strong displacement. And, it doesn't matter which one you enter on. It could have been on this fair value gap here on New Zealand, or this one here. So what I've showed you here, my risk reward tool. I didn't take this trade, but I did post about it just a little while ago on Twitter. And we have this buy side liquidity just above, and price really shot up. I think there was a news event. So you can see how powerful this can be, not only on index futures, but also in Forex. And for a higher time frame perspective, on Monday, we've come down, made this this low, taken out this candle's low right here, and here hit this imbalance. So, would we be surprised in the next session and the next day to see some sort of move up? I don't think that's a surprise if you study ICT. So you can see that this can be applied in other asset classes. While we're on that topic, we can see that we also had a setup at New York Open with EU and GU. So I don't really trade these so much anymore, especially not during New York session, but I just wanted to show how the same concept can work in Forex. I don't know how often it works. I don't know the frequency. Here we can see we just have to use a different time. So New York Open in Forex is 8 a.m. And if we just mark that 8 a.m. price on both of them, so that will be just New York Open, we can see that prior to New York Open, we had the liquidity grab right here on the pound. So we'll just make that as the higher high, and we can see at the same time, we see euro dollar making lower highs. We have a type 1 liquidity grab, so prior to the open. Now we need our displacement. So if you go to the 5 minute, you can see that at the time of New York Open, we do have this balanced price range right here. I think on the 1 minute, you can also see a displacement here down prior to New York Open. So you get at the time after New York Open, you get this optimal trade entry pullback. Notice how the 62% is perfectly in alignment with the fair value gap here on this down move, as well as the higher time frame 15-minute fair value gap. So this was a very nice setup, and it hit our sell side liquidity target at the end of the hour, or at the very, very beginning of the next hour. So at 9:02, we hit our target. So I just love that. That's just a beautiful, what would that have been if you got in right around here? So that's a 5-hour trade in under an hour. So I love that. So cool to see. I might start paying attention a little bit more. I don't plan on trading this during this time zone, but I'm curious about more of these Asia session setups, just because it does fit into my time of day, being on the west coast of the US. So just wanted to point that out. Now, if we go to today on the ES, and if we go to the Nasdaq, so I'm going to go over some the opening range play from today, as well as the some of the DR scenarios that I saw today. if you are someone that is not interested in the DR, I think you'd still be interested in seeing this, because it's basically, you don't even need the DR for this type of setup. It's basically an ICT setup, but it just adds another layer of time, of the time element, and more of a framework from the DR. So I still think it's worth checking out. But for now, let's talk about the opening range setup. So I was, admittedly, to start the day, I was a little bit mixed on what I wanted to do. I was leaning bullish, but open to the possibility of bearishness. Why? Because we've been pushing up, so want to stay bullish, like don't want to guess when the top is going to come in, so to speak. But we've taken out buy side liquidity. We've hit what could be, especially, I'll say, like, I think ES is a little bit what made me even more conflicted. Let's start on that, because here we've been pushing up, yes, which is bullish, but we hit this buy side liquidity, this big wick, and, hit this up close candle right here, this rejection block, and then formed a, so let's just focus on this for now, and then formed a swing high after the close of Friday. Why is it a swing high? Because we have two candles on either side, right here and right here, that are lower highs. So we hit buy side liquidity, we form a swing high. When that happens, we certainly need to be on guard for a retracement. And we started to get that with the break below Friday's candle on Monday. And so that was one reason why even though I'm leaning bullish, because I do see that we have some areas here that we could be reaching for, and I don't want to guess when this move on the daily chart is going to end. I need to see more evidence of bearishness coming in. So, but I don't know, is that bearishness going to happen today? I had no idea. So I was open to the fact that yes, I am bullish on some levels, but I'm also bearish on some levels. So by that logic, I'm more 50-50 based on the higher time frame, and therefore any trade that I take, or that I'm going to take, I'm not going to be adding to positions. I'm not going to be holding to long targets. I'm going to manage the trade a bit more aggressively than just sort of letting it go and not paying attention to it. And that's just me. That's just what I want to do in that situation, because of what I just said. So knowing that, having said that, we also had this opening gap from the weekly, from the Sunday open. So the market opened up Sunday, created this gap. So we have this, volume imbalance, this gap from this candle's close to this candle's open. And so, you can see I have these lines here. I'm just going to delete it right now, because I'm going to turn on my, I think it'll be a little bit cleaner to see my weekly open indicator. It's just an indicator that plots the weekly open and the monthly open. So that's what this level is. And it's just so the bottom end of this, basically this gap, this opening gap. And we had one on S&P, and we had one on Nasdaq right here. It's more or less the same area. So I'm just going to use that to be clean. But for this demonstration. So first thing I noticed, so that was the view on the higher time frame heading into the session. Then when we got into actual New York Stock Exchange open, let's take it back to this first candle. So, well, first of all, let me do one thing. How do I do this in the fastest way? Okay. So first of all, I want to point out that on S&P, this is a weekly level. This is a previous week's high. So not last week, but the week before. And so that's an area of interest, an old high, which we've impulsed through. And before New York open, we had seen, so this was in London, price had come into this level. I believe there was divergence right here. So focus on this area here, right at that low. So we're here. Yep. So see this? That was what I was just showing you right here. And we can see that. Here, I'll just do it on this chart too, so you can see it. Let's just use this for now. So in London, we can see that we had come into this point of interest. we had made this divergence here, SMT. So we have this extra liquidity grab down here. S&P makes a higher low. Nasdaq makes a lower low. Then we get a displacement up and come back down to a discount and then rally up. So we're in the finishing stages, if you will, of this move from low to high. Now, so there was no trade at the open because I saw this as, okay, maybe this was a type 1, but price had already come down into the discount area prior to New York Stock Exchange open and then reacted off of it. So there was no trade. Remember, a type 1 is a pre-market liquidity grab, but you get the entry after the displacement. So the displacement would come before 9:30, and then your entry would come after 9:30 when price comes down into the discount area. In this case, it had already played out ahead of time. So the only play I really had was a type 3 situation, which is a false start. So we have this push up at the open. We're not surprised that we've been pushing up because we're coming off of this weekly. And on the Nasdaq, we have a daily volume imbalance, which I'll show you as well, which is what that blue box is. So we're at this daily volume imbalance. So this is also an area of support. Actually, let's go to the 1 minute. Expansion up at the open, sudden move, false start. Everyone chases. The market comes back down, runs the low below the opening price and below this swing low. There's some inefficiency here as well. And at the same time, we can see that we have this fair value gap on Nasdaq. So Nasdaq's making a higher low at the same time as S&P is making a lower low. So relative to this swing low right here, so if you look here, we want to use lows that happen at the exact same time. And so there's always there's a couple things. The earliest entry that maybe you could have justified, like kind of anticipating, was, hey, we've come below the opening price here on S&P, and on Nasdaq we're actually like moving up. But for me, I wanted to set my order basically at this imbalance. That's where I wanted to enter as close as possible to. I actually got in like a little bit above. And then I put my stop. Now, the mistake I made today, I sized for my position with the stop below the swing low. And I really think that my stop should have just been below this candle, which is not a major difference. It's like 5-6 points, I think. But whatever. So it's not a huge deal. But anyway, the point I want to emphasize is how did price react once I got involved in the trade. So I got in here, and then price came down again here. And now we want to keep in mind always the time. So I'm going to mark out 10 a.m. I can mark out 10:30 as well. So we know that 10 a.m. can be a time for a turnaround. As we said, if in that opening range video, I talked about that. And then I also talked about how, if you remember, at some point in that video, I talk about how we want price action we want to be in tune with what price action is doing once we're in the trade. And that can help us be informed on how long we want to be in the position for. And so, as I said, to start the day, I'm feeling a mixed bias on the daily to some degree. There's reasons to buy and there's reasons to sell, to be honest. And so when I have that in the back of my head, combined with the fact that this wasn't a situation like in some of those other examples I showed you in that video where we just tap the level and then fly. So we've seen those in those examples where it's like everything's lining up to be bullish. We come into our level, we tap into it, and it just like explodes off of the area. So if I had seen that, I probably would have hit my target because I was keeping a tight target anyway to the weekly open, which is not on this chart, regretfully. But it's this white line. But anyway, let's say it wasn't this. Let's say I didn't have a target at this weekly open necessarily. But I would have wanted to have seen price explode off the level if we were really going to be bullish and or was going to push for this 10:30 or noon time period to close the trade, or to hope for that time for a higher time frame liquidity target to get hit. Let's say I really wanted, this imbalance or something like that. But reading the price action from the point I enter the trade, I can see that we are just chopping. We are just moving very sluggishly. We are dealing with a lot of congestion. So yeah, it's like we're like that traffic analogy. We have the green light to buy. We have our setup. We have our justification based on the higher time frame, but also based on the higher time frame, we know that we're heading into an area of possible resistance, and we're starting to see this congestion right here while we're in the trade, and we're waiting it out. And now we're getting closer and closer to 10 a.m. And so at that point, once we got to 10 a.m. to right here, I was feeling pretty good because I liked how the structure was looking. I liked how S&P was starting to push up as well, but I definitely moved my stop to basically about break even once we started getting closer to 10 a.m. And at that point, so I wanted to protect myself because I knew we were heading into some congestion. We know 10 a.m. can be a time where price turns around, and sure enough, it hits our target shortly after 10. Does end up doing one extra manipulation move higher, and then we get the breakdown. And on S&P, so I chose the right one because clearly S&P did not make the higher high, and that's what's going to happen. That's why it's important to make that decision as best you can on which one to be involved in. So clearly we got the better setup. This just looks stronger with a fair value gap than this raid. But the real reason why I wanted to focus on Nasdaq was because Nasdaq, the setup occurred inside, right at the edge of this daily volume imbalance. So if I go back, you can see that the setup itself, that blue box, the top of the blue box, that's basically right where my entry is. So we're pushing up through it. So that's what I like to see first and foremost, is a higher time frame level that overlaps the lower time frame setup. So I have a reason to buy on both time frames essentially. And then meanwhile, at the same time, S&P had also a volume imbalance, but it had been trading below it. So you can see this is where the volume imbalance is on S&P. And so that's what this gray box is. And if I go down to, let's say, the 5-minute now, you can see that the same setup, we're pushing into it. So it is a area where we could expect to target, and it did come very close to it on this first push up. But clearly I don't have a similar level in line with my entry on the lower time frame. There's no equally good higher time frame level here like I had on Nasdaq. So that was why it was an easy choice for me to choose Nasdaq today. So moving on, I want to then go back to this chart and talk about the DR. So I think the first one, so we had it on both. Let's look at S&P. So this is why I like it better, for the same sort of reason as what I was just talking about. This is that previous week's high that we talked about, how price bounced off of in London. And now we have a DR scenario 2. What's a scenario 2? We have our range that's formed, and we have a wick rejection, essentially, of the DR low in this case, at a higher time frame point of interest. So not only are we at this old high, this previous week's high, we've also run the liquidity here from this move here, the lows here, and now we're back inside this range. So that is a great setup. It's not just taking every scenario 2 that technically forms. It's looking at the overall framework and looking at other confluences to build a picture. And so here we have the close. So sorry to jump back and forth all the time. This candle closed at 735. So the wick confirmed as a wick at 735. So here we are at 735. Do you enter here? Well, you could. I wouldn't. I just like to look for basically the same setup that we're always trading with ICT. So, we're inside now. This is once we're inside, see this up close, these two candles here. Once we're inside this is a breaker. It's like you're anticipating that this is going to be a breaker. You have this imbalance on the upside right here. Very subtle, but it's there. So that could have been the entry. That's a very nice trade. 3R to the high. Could have taken it just to these highs. Could have been very, very lovely trade. And then now, I mean, that's not the only one. I mean, you could see as well, first of all, that Nasdaq had the same thing. Rate of the low. It actually clipped this low too. We're still in this higher time frame point of interest, this volume imbalance. Nice close. We come back down to the lower time frame. And we have our model. So notice how a wick on a 5-minute candle is our entry model on a lower time frame. So that's something important to remember, I think. And then you have your entry, pushes back up, then you get to the high. And now what are we doing at the high? We're doing the exact same thing. It's a DR scenario 2 to the sell side. So in this case, now our point of interest, now we've established reasons on the higher time frame to why we could be bullish or bearish. We're just operating at the extremes of the range. And in this case, we're now inside this opening range, this opening gap. We have this wick and then this wick, but so why would you not enter on this wick? Well, it's not that long of a wick. This one is more of a rejection, but more than that, it's the lower time frame model. It's what that 5-minute wick represents on the lower time frame. We come up, smart money reversal. We have our little fair value gap here. Displacement below the short-term low. We come up, we get the entry. So this could have been the entry. You know, in this case, if I were to trade this, I didn't trade it because I was done after my first trade. You know, I wouldn't want to put it right here, even though you probably could technically below the fair value gap. It would have worked, but I wouldn't have felt very comfortable risking, you know, real money on that or serious money on that. And this would have been a little too high. So I would have looked at this big up close candle and put it above about the mean threshold, about the 50%. So something like that would have made sense to me. And then I would have targeted, you could have targeted this swing low right here. So, you know, about 3.5, 3 to 3 R, if you felt like you could push it back down to the volume imbalance, you know, you would have had a nice trade there. So lots of opportunity today. But this was just a sideways day, and it feels, what I love about this is just to go back to the opening range. We'll finish on this again. What I love about this is just that, you know, I was in the market here at 643-ish. And then I was out here at the weekly open. It's really about almost 60 points in under 20 minutes. And then I'm pretty much done on a Monday, especially because I don't want to give money back to the market on a Monday. I'd rather take my win and just have a nice little cushion for Tuesday and Wednesday, especially when I just have conflict on the higher time frame. Whenever I have conflict on the higher time frame, I really don't want to push it too much. That was it for today. That's all I wanted to talk about. I hope this was informative and not too long of a video. But if you enjoyed it, please leave a like, please comment, and hope to talk to you guys again soon. All right, have a good one. Bye.